Good morning, venture capital. This is Metagame, and today we're following $59 billion to find out who it skipped. $300 billion. That's the number that hit your feed in April. That's the number that made limited partners nervous, made allocators second-guess their deployment pace, and made every founder with a deck suddenly feel like they were late to a party that had already moved on without them. Here's what nobody told you. That number is real, and it has almost nothing to do with the market you're actually investing in. Let's do the surgery. The SEC's Q1 Form D dataset clocks in at $256 billion across 1,003 filings. Add the amendments and re-ups, and you get to $300 billion. Sounds like a roaring market. Now strip out 4 deals. Just 4. The $122 billion OpenAI raise, the $30 billion Anthropic check, the $20 billion XAI round, the $16 billion Waymo haul. Strip those out, and what you're left with is 586 fresh filings, $59.3 billion in genuine new deal formation, and a median deal size of $22.9 million. That's it. That's the market. Not $300 billion, $22.9 million. Those two numbers describe completely different games, and most VCs are running the wrong mental model into the wrong scoreboard. The distortion is directional, and that's what makes it dangerous. When $193 billion concentrates into 41 deals, 76% of all SEC-filed capital flowing into 4% of transactions, it creates a perceptual gravity well. The headlines drag your attention upward. Infrastructure, foundation models, frontier compute, the names that rhyme with civilization-scale bets. And while you're looking up, the $10 million to $100 million bracket is quietly running 794 deals in a single quarter. That's 13 deals per business day. The field's not empty. It's just not loud. Let me break this down directly. The average deal size in Q1 was $255 million. The median was $22.9 million. Average is the number you get when 4 deals averaging $4.7 billion apiece share a spreadsheet with 582 normal deals. Median is the number that tells you what the modal transaction in U.S. private markets looks like, and it looks like a Series A in a vertical workflow company that didn't make TechCrunch's homepage. The average is a statistical artifact. The median is your market. Know which one you're reading. Now here's where it gets structural. Redpoint published their market update, and 2 numbers jumped out. Vertical SaaS multiples, up 3%. Horizontal SaaS multiples, down 35%. Read that again. 35% compression in horizontal software while vertical holds and grows. That is not a blip. That is a category rotation that already happened while everyone was staring at the foundation model scoreboard. Why is horizontal getting crushed? Because the ROI story for broad enterprise software is broken. Pilots are failing. Adoption is stalling. The pitch of, deploy this across your entire organization and watch productivity compound, is running headfirst into the reality that most enterprises can't execute that deployment. The bottleneck isn't model quality anymore. It's not API access, it's implementation, it's workflow integration, it's the last mile between a capable model and an actual business process that runs differently. Vertical software wins because it doesn't ask the enterprise to change. It embeds into a specific workflow, eliminates a specific cost center, and delivers a measurable outcome inside a domain the buyer already understands. Financial operations, healthcare workflows, legal tech, industrial ops. These aren't horizontal tools with a vertical marketing layer painted on top. That's a different thing, and the market is getting good at telling the difference. Genuine vertical software is commanding premium multiples right now because it's the category that can actually close the gap between AI capability and enterprise adoption. The pillar raise is a clean example of what this looks like in practice. A $20 million A16Z-led seed round for AI-enabled financial risk workflows, ingesting contracts, ERP data, commodity exposure, FX risk. That deal sits exactly at the $22.9 million median. It's in a vertical workflow category, financial operations, that didn't exist as a fundable category 3 years ago, and it's the kind of deal that doesn't generate a 3-day news cycle, doesn't get the infrastructure scale treatment, and doesn't show up in the $300 billion headline. But it's precisely the deal that defines the application layer opportunity right now. Cursor's reported raise at a $50 billion valuation is the other end of that same spectrum. Same application layer, same category logic, different stage in the power law curve. The market that produces $20 million seeds also produces $2 billion growth rounds when enterprise pull is strong enough. The application layer isn't a small deal-only market, it's a full-spectrum market that rewards precision over scale at entry and compounds into category leadership at exit. The early-stage entry point is just the most accessible and the least competed over. Here's the number that should be reframing your Q2 outlook. Early-stage AI and machine learning deal count is up 41% year over year. Crunchbase tracked roughly 6,178 AI deals across all of last year, and the overwhelming majority of those were sub-$50 million. The mega rounds get the headlines. The other 6,600-plus deals are where the game is played. That is a generational deployment wave at the application layer, and it is running largely beneath the coverage cycle that shapes LP perception and fund manager confidence. The PitchBook NVCA Q1 Venture Monitor flagged it explicitly. Capital formation at the AI application layer is easier right now than at the infrastructure tier. Capital efficiency is higher. Product distribution is faster. The unit economics of a vertical workflow company with a defined buyer, a defined use case, and a defined cost elimination story are fundamentally different from the unit economics of training a frontier model. The investable surface area is expanding, not contracting, even as mega-round capital concentrates at the top. And here's the signal that tells you the bottleneck has moved. OpenAI and Anthropic are reportedly in talks to acquire AI services firms, companies that handle implementation, deployment, and workflow integration. Think about what that means. The frontier model labs, with effectively unlimited capital, are looking downstream at services companies because that's where the constraint is. Not compute, not parameters, implementation capacity. The gap between enterprise demand and successful deployment is where the value is accumulating, and the largest players in the space are already moving to acquire into it. The question for early-stage fund managers is whether you're positioned ahead of that acquisition wave or behind it. So let's close the loop. You started this episode with a $300 billion number and a vague sense that the market had left you behind. Here's the corrected picture. The $300 billion market is real. It's also 4 companies and a handful of sovereign wealth funds writing checks that no $200 million AUM fund competes for. The $59.3 billion market is also real. It's 586 fresh deals, a $22.9 million median, 794 transactions in the $10 million to $100 million bracket, a vertical SaaS category holding premium multiples while horizontal compresses, and an early-stage AI deal count growing 41% year over year. Those are not the same market. They don't share a scoreboard, they don't share a competitive dynamic, and they absolutely do not share a deployment strategy. The perceptual gravity of mega-round coverage creates a specific risk for institutional allocators. You read the $300 billion headline, you assume the market is overheated or inaccessible at your check size, and you slow your deployment cadence going into Q2. That is precisely backwards. The $10 million to $100 million bracket ran 13 deals per business day in Q1. Funds that allow headline distortion to freeze their conviction may find themselves underweight in the application layer vintage that produces the next cohort of category leaders. The $300 billion number is real. The $22.9 million number is also real. The only question that matters is which one describes the market your fund actually competes in, and whether your deployment pace in Q1 matched the opportunity the data shows was actually there. Because the rotation from horizontal to vertical already happened. The early-stage AI wave is already running, the implementation bottleneck is already being acquired, the 794 deals in the bracket where you write checks already closed. The question going into Q2 isn't whether this market is open, it's whether you showed up. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.